Welcome to The Explainer. I am absolutely thrilled you're here with us today. We are unpacking a deep dive, Bain-style competitive analysis of India's absolute top discount brokers. We're looking at a true heavyweight clash based on the latest FY25 data, Groww versus Angel One. So, let's dive right in and uncover what the numbers are really telling us.
To truly wrap our heads around the sheer scale of what we're looking at today, we kind of have to rewind just a bit. Back in March 2021, India had exactly 55 million Demat accounts. To put that into perspective, that's roughly the entire population of South Korea. That was the whole universe of retail investors participating directly in the Indian equity markets.
Now, what's really interesting about this slide is where the sheer explosion happens. By October 2025, that number is projected to hit a staggering 210 million Demat accounts. I mean, think about that for a second. It's literally like adding the populations of Germany, the UK, and France combined to the market. That is a massive, 4-time structural shift in the Indian economy. We're witnessing the financialization of savings on a scale we've just never seen before. Okay, so here's our roadmap for today. It's pretty straightforward. We'll start with the structural broking boom, then jump right into the FY25 financial showdown, analyze their competitive moats, break down their strengths and weaknesses, look at some looming sector risks, and finally, deliver the source's objective investment verdict.
All right, Section 1, the retail broking boom, a structural shift. So who actually benefited from this massive 4 times market expansion? Well, the answer is unequivocally the digital-first discount brokers.
Just look at the active client market share as of April 2025. The dominance is super clear here. Groww is leading the pack with a massive 37.5% share. Then you've got Angel One in this fierce neck-and-neck battle with Zerodha for the second spot, sitting at 22.1%. And notice the massive gap here, right? Traditional bank-backed brokers have essentially been entirely squeezed out into that tiny others category.
Now, this kind of growth, it didn't happen by accident. Mobile-first millennials are driving over 80% of these new account openings directly through apps. But the real battleground, the place where this war is actually being won, is Tier 2 and Tier 3 cities. They account for over 60% of new investor additions. There's a catch, though, which we're going to discuss heavily today. SEBI's recent regulations on futures and options are actively changing the revenue math for all these players.
Moving on to Section 2, the FY25 financial showdown, growth versus profitability. It is time to put all the flashy marketing aside and look at the hard FY25 data to see how these two giants actually make their money.
Let's start with absolute revenue. While Groww has incredible momentum, they are growing at an astonishing 49% year over year. The legacy player, Angel One, still brings in significantly higher total cash. They're sitting at 5,238 crores compared to Groww's 3,902 crores. So Angel One is monetizing its existing base incredibly well.
But here is where the story completely flips. How much of that revenue actually makes it to the bottom line? So the crucial point is looking at Groww's sharp 3 times profit growth. They absolutely rocketed to 1,818 crores in FY25. Meanwhile, Angel One actually saw a 19% drop in net profit, down to 1,141 crores, and that was heavily impacted by those SEB headwinds we touched on earlier.
The financial dichotomy here is just fascinating. Groww operates at a staggering 45% profit margin, giving it a massive estimated private market cap of around 97,000 crores. And because of that scale, it carries a really premium price-to-earnings multiple up to 41x. Angel One, on the other hand, they're the quintessential value play. It trades at a much more comfortable 19x multiple and pays out a steady dividend of 11 rupees per share. Simply put, Groww is selling premium scale while Angel One is offering value and income.
Section 3, competitive moats, battle of business models. Beyond those raw FY25 financials, how do these companies actually protect their market positions from competitors? What's keeping them at the top?
Looking at their core structural advantages, Groww's moat is built pretty much entirely on code and culture. They have an incredible brand recall among the youth and a super lean tech infrastructure that acquires customers at a remarkably low cost. Angel One, however, has a massive physical moat. They leverage a network of over 9,400 authorized persons spread across 5,000 PIN codes. So Groww wins online, but Angel One has deep roots offline in those crucial Tier 2 and Tier 3 cities.
Let's hit Section 4, strengths and weaknesses, platform versus legacy. It's time to dive a little deeper and break down the vulnerabilities hiding behind those impressive market share numbers we just saw. So, looking at Groww's profile first.
The strengths are completely undeniable. They have 1.25 crore active clients, and remarkably, get this, 83% of their user acquisition is completely organic. They just aren't burning cash on marketing, which fuels that best-in-class 45% profit margin. But look at the risk here. 85% of their revenue is highly concentrated in active trading. If the broader market slows down, Groww takes a massive direct hit. And with their premium valuation, there is practically zero margin for error.
Now, shifting gears to Angel One. Their biggest strength is definitely their shield, diversification. Actually, they aren't even just a broker anymore. They're expanding into wealth management, lending, and their own asset management company, all backed by decades of regulatory trust. However, the red flags are there. Their active client base is only 60% of Groww's, meaning they are kind of losing that younger generation. Plus, their reliance on derivative volumes meant that when SEBI introduced new curbs, their Q1 FY26 profits plummeted by a massive 60%. That is a staggering hit for sure.
Section 5, Sector Risks and Disruption, the Looming Shadows. We have to ask, what could actually derail this massive structural boom for both of these giants?
Well, there are severe macro threats hanging over the entire sector right now, and this brilliantly illustrates how the absolute highest near-term risk is step 1, SEBI's new futures and options regulations. By increasing margins and contract sizes, SEBI is actively trying to cool down the speculative retail trading that these brokers so heavily rely on. Following closely behind that are potential transaction tax hikes, disruption from sleek new AI-native fintechs, and of course the ever-present threat of a bear market downturn just wiping out retail participation altogether.
And that brings us to Section 6, the investment verdict, growth or value. Based strictly on the comprehensive research framework provided in our source material, how do we objectively weigh these two giants against each other? The source material summarizes the entire thematic tension of this analysis with one really powerful quote. Groww is India's growth story. Angel One is India's profitability story. It's the classic battle, right? Paying a premium for exponential user acquisition versus seeking value in diversified, established monetization.
So, who does the source ultimately pick for a 3-year horizon? Well, the verdict lands on Angel One, and the rationale is highly objective. It basically comes down to a margin of safety. While Groww is priced for absolute perfection, Angel One offers real valuation comfort at a 19x multiple. The source argues that Angel One's durable physical distribution network is just much harder to replicate than a purely digital app. Furthermore, their rapid diversification, combined with the fact that recent regulatory hits are likely already priced into their stock, makes them the preferred value play.
So, that leaves us with a genuinely fascinating question to chew on. Which model will truly dominate the next decade of Indian retail investing? Will it be the pure tech-driven low-cost scale of platforms like Groww, or the diversified physical meets digital distribution network of legacy players like Angel One? I highly encourage you to keep exploring the data as these heavyweights battle it out. Now, before we officially wrap up this explainer, please note the following mandatory compliance requirement.
Disclaimer: I am a qualified chartered accountant and may share my personal views, observations, and educational content related to financial markets, investments, accounting, taxation, and related subjects. However, I am not registered with the Securities and Exchange Board of India, SEBI, as a research analyst or investment advisor. Any information, analysis, opinions, or views expressed by me are purely for educational and informational purposes only, and should not be construed as investment advice, stock recommendations, or financial solicitation. Investors are advised to conduct their own research and consult a SEBI-registered financial advisor before making any investment decisions. Further, I may personally hold shares, securities of companies discussed or mentioned, including shares held through my personal investment portfolio. Such holdings may change from time to time without prior notice.